Tony, let's go ahead.
Good evening and welcome to Acuité Ratings and Research Limited's virtual discussion titled Reconstructing India, Recovery and Potential Risks. I'm Anthony Jose, Chief Rating Officer at Acuité Ratings. As you may be aware, Acuité Ratings is one of the established full-service rating agencies in India. Acuité has assigned ratings to more than 8,500 entities. We were one of the pioneers in SME ratings, which started in 2005, and as on date, we have rated over 50,000 small and medium enterprises. We are the first rating agency in India to launch ESG ratings through our subsidiary ESG Risk Assessments and Insights Limited that we set up very recently. Coming to today's topic of discussion. As we all know, FY21 has been one of the most challenging years for the Indian economy. The COVID pandemic aggravated the ongoing economic slowdown, which led to an unprecedented contraction in real GDP by 23.9% in the first quarter of 2021. Subsequently, however, we have also seen early signs of recovery, which is likely to be bolstered further by the promising union budget. To start the proceedings, we'll have a short presentation on the current economic scenario by the lead economist of Acuité Ratings, Mr. Karan Maharishi. Over to you, Karan.
Thank you, Anthony. So before our esteemed panelists convene, I would like to give you a brief overview of the macroeconomy. This is the content that we will cover in today's brief presentation. So let's start with the elephant in the room. As far as the budget FY22 is concerned, it's your typical market borrowing dominated, very Keynesian budget, where the government of India is taking on the mantle to get the economy back on track. This is primarily driven by an expansion in capital expenditure, which is expected to grow by around 34% YOY BE. For the uninitiated, capital expenditure is the holy grail as far as economic recovery and sustainability is concerned. It is noted that every 1 rupee invested in infrastructure percolates into 240 different sectors. This is somewhat reflected in the very high fiscal deficit numbers of 9.5% for the current financial year, RE, and 6.8% for the next financial year. That is almost double to the FRBM mandated 3.5% to GDP. Capital expenditure is, however, not the only driver of these numbers. The other important drivers and consideration include the on-budgeting of several subsidy items, most specifically the FCI loan, which was earlier financed through off-budget sources, but from this year onward, that is also now part of the budget estimates. Also, so this is adding about 2 to 2.2 lakh crore to the fiscal deficit. Additionally, the government of India also borrowed around 4.2 lakh crore in the current financial year to compensate for revenue loss because of the COVID-related lockdown. So this is adding a further 4.2 lakh crore to the fiscal deficit. As far as the government's revenue estimations are concerned, the projections seem fairly realistic and credible if we compare them with the revised estimate of the current financial year. But given the fact that the current financial year saw a black swan event, and the fact that the GDP by the end of the next financial year would be almost the same size as it was at the beginning of the crisis, then it also is prudent to have a BE YOY comparison. So a quick calculation reveals that the government has significantly pared down its revenue estimates, both tax and non-tax revenue, by around 12%. This is also giving a sense that the Ministry of Finance is probably undermining the growth potential of the economy, or it is just being cautious as the economy evolves further. As mentioned, the primary focus of the budget remains infrastructure by way of development of road, railway, and healthcare. There's also renewed focus on recapitalization of banks, given the fact that such an important role commercial banks have played in the macroeconomic stability of the economy in these difficult times. So the capitalization plan is around 2 lakh crore worth of infusion. There's also a special mention of an ARC or asset reconstruction company. The belief is that this ARC would take over non-performing assets from bank balance sheets, giving them the much needed breathing space. However, the modalities of this ARC are still not clear, and we await more details to comment on this further. Challenges, however, remain. Even though I just mentioned that the government of India has pared down its revenue expectations, but judging from the past trends, it is quite clear that as far as non-tax revenue is concerned, generally it is an underperforming class where the government is not able to meet those targets effectively. But having said that, for all sense and purposes, the FRBM Act has gone out of the window, and that has opened up a significant window for the government of India to compensate any deficits in its estimates, and that can be taken care of the market borrowings. So FRBM mandate, as expected, would not come back online until 23-24. And therefore, this leaves a lot of space for the government to depend on market borrowings as we move forward. Coming to the high frequency macro variables, our proprietary heat map, which is a composite of over 30 high frequency macro variables, is suggesting that things have drastically improved. The latest version is suggesting that in almost all departments, high frequency variables are back in the green. If you compare this to what was happening in the month of April, everything was in a red. So there's a paradigm shift as far as recovery is concerned, and we may actually looking at the so-called V-shaped recovery. Also evident in the image on your left, more than 50% of the IIP basket has already achieved pre-COVID levels of output. The same story is evident with the trade numbers. Also evident from the improving mobility indicators, that is giving us a sense of robust household consumption sentiment. As far as the CPI is concerned, we remain very vigilant about this. Even though the headline CPI number has remained elevated since November 2019, but the COVID-related lockdown and its implication on the supply chain has exacerbated the situation. And therefore, in the first 9 months of the current financial year, the CPI headline number has averaged around 6.7 to 6.8%. We were expecting the CPI headline number to moderate by September 2020 because of a favorable base effect, but unfortunately that did not happen. However, given the staggered effect of the Kharif produce, along with availability of seasonal vegetables and expectation of a bumper Rabi output, is having a profound effect on the food items of the CPI basket. Now, if you look at the right on the table, then the food prices or the food basket was averaging around 7.6% in Q3 of the financial year, and it was last logged at 2.6%. So there's a significant decline. And given the fact that food basket is contributing to almost 43% of the overall CPI basket, it is having a very profound dampening effect on the overall CPI number. As far as core inflation is concerned, as global economy recovers, there is a scramble for commodities, and there's a significant mismatch as far as demand supply is concerned. Pressures are already seen on the intermediate and basic industries. To give you a context, FY20 average for core inflation was around 4.5%. This year's average is a significant 100 bips over that level. Now, this has implications to the fledgling household confidence levels. To give you a context, again, regarding what the implications would be, as companies regain pricing power, escalating costs would be transferred to the households, and that would sort of have a negative implication on the improving consumption patterns. The same picture is evident from the WPI story as well. Because the inflation number is now moderating, we have revised our CPI forecast for the current financial year to 6%. This was earlier estimated to be around 6.5%. This will further moderate to 5% in the next financial year. However, it will remain a function of how and how much the Iranian oil supplies replenish the crude market, and also how quickly and effectively corporate India, along with the government, are able to get the supply chain back on track. As far as the liquidity is concerned, the Monetary Policy Committee has provided accommodation to the tune of 250 bips. That has translated into significant systemic liquidity, as measured from the reverse repo operations under the LAF window. The average liquidity in the system is around 5.2 to 5.3 lakh crores. Effective management of this liquidity is the litmus test for the efficacy of the stimulus package provided by the Government of India and the effectiveness of all the monetary policy tools that are employed by the RBI. This has very significant implications on the entire yield curve. Already, signals are emanating from the money market rates. If you look at this policy corridor, then WACR, or the weighted average call money rate, which is the rate at which banks borrow from each other overnight, has been consistently trading beneath the reverse repo rate. Now, the reverse repo rate is supposed to be the floor or the minimum hurdle rate in the system. So whenever the WACR is trading near or beneath it, it signifies that systemic liquidity has become unsustainable. If we look at about 2 weeks ago, this was the picture when the WACR was actually trading 20 bips on average beneath the reverse repo rate. Also, looking at the money market rates, a 91-day treasury bill was going at 1.93 overnight, and a 364 treasury bill was going at 3.1, 3.12 overnight. That's on average around 40 and 20 bips respectively lower than the reverse repo rate itself. However, over the last 2 weeks, we have seen some kind of moderation. Banks have been finding it hard to part ways with the short-term liquidity. This is because they have become more aggressive as far as they are concerned in taking back their lost market share to money markets and capital markets is concerned. Also, this is evident from the fact that the RBI's 14-day term money market operation did not elicit much response, and commercial banks wanted to keep the short-term liquidity at hand. Given the fact that credit offtake numbers are already breaching the critical 6% threshold, and credit deposit ratio is now almost normalizing, we are anticipating that banks believe that credit offtake levels are normalizing as we speak. Continued accommodation has put pressure on safe haven assets, and that is evident on the 10-year American G-Secs as well as gold, both of which have lost some of their values respectively. However, short-term liquidity has ensured that money market rates as well as short-term duration instruments have remained sub 30 bips as far as the global situation is concerned. However, looking at India, the 12 lakh crore calendar that has exceeded 12 lakh crore in the current financial year and continues to exceed 12 lakh crores in the next financial year. It is actually spooking the fixed income market, and there has been renewed upward pressure on the entire yield curve, especially the long end. Most of the market experts that we're talking to believe that even though the RBI wants to keep 10-year G-Sec range, yield range in the vicinity of 575 to 591, but a 6.4, 6.5% range is not far-fetched. So that is something that we may incorporate in our valuations looking forward. As far as the rupee's value is concerned, vis-a-vis the dollar, record capital inflows from abroad have been persistently shoring up the rupee's value. Our rear estimates reveal that the rupee's fair value is somewhere in the range of 68 to 69. However, the RBI is leaving no stone unturned in stopping the appreciation of the rupee, because that would be detrimental to the exporter sentiment, and therefore the rupee is languishing in the vicinity of 72 to 73. But having said that, there's a very peculiar characteristic of the balance of payment picture as it is evolving in India, where we have a surplus current account as well as a surplus capital account. This situation invariably leads to an overfinancing of the current account, where some of the money may be crowding in domestic savings and may be put into infrastructure investments, but the rest of the money generally gets into domestic asset classes, inflating them. Ultimately, this provides a covered interest arbitrage opportunity for global investors, and more money flows in. So there's a huge possibility that not only would there be capital driven inflation in the domestic assets in the short to medium term, but also continued flow of capital, which would elevate the rupee's appreciation further. So it now depends on how effectively the RBI is able to manage the rupee's value. Talking about the global economy, the theme remains that it is all driven by fiscal expansion and monetary accommodation. But the question is that for how long would it last? Now, we are very much concerned about a taper tantrum kind of a situation that might occur after any kind of commentary that comes from the US Fed or the ECB. Traditionally, whenever such an event has occurred, it has had detrimental effects on the hot money driven valuations of Indian capital markets along with other emerging markets. So that is something that we are quite vigilant about, even though the US Fed along with the ECB are clear that accommodation would last for at least 2 to 3 years more. But given the fact that the US is already attaining the target range of 2% of inflation, 4% of unemployment, the European Union is also not that far away from those targets. It actually is prudent to assume that recovery could actually be faster than most policymakers are anticipating at this point in time. Looking ahead, we are of the belief that the Indian economy would be growing by around 11% in real terms and 15% in nominal terms, with an upward bias of at least 100 to 150 bips. But the sustainability of these numbers will be dependent on three factors. Number one, how effectively the government of India would be able to safeguard its revenue sources. Number two, how effectively the RBI would be able to manage the systemic liquidity. And number three, how long would the global accommodation last? So the sense is that it should last at least a year, so that the economy finds its legs and is sustainable in the medium to long term. That is not just an expectation, but also a hope. I conclude my presentation here. Over to you, Anthony.
Thank you, Karan, for setting the background for this discussion. With that, we will now turn to our distinguished panelists. Our first panelist is Dr. Shubala Rao, founder of Quantico Research. Dr. Rao has a rich understanding of the Indian economy through her experience of over 2 decades as the chief economist in large Indian banks and financial services companies. Good evening, Dr. Shubhada Rao, and welcome to the discussion. We also have with us Dr. Amiyatosh Purnanandam, professor at Stephen M. Ross School of Business, University of Michigan. He specializes in banking, risk management, and corporate finance, and keenly tracks the economic developments in India. He has extremely strong academic credentials with a doctorate in finance from Cornell Johnson Graduate School of Management, an MBA from IIM Lucknow, and a degree in electrical engineering from IIT Kharagpur. Thank you for joining us, Dr. Amiyatosh, and good morning to you, since you join us from the US. From Acuité Ratings and Research, we have with us Sankar Chakraborti, Group CEO, and Suman Chowdhury, our Chief Analytical Officer. Before we start, I will want to draw the attention of all participants to the chat box. If you have any questions after the panel discussion, please post them in the chat box and we'll try to answer them towards the end of the session. So without further delay, I'd like to hand over to Sankar, who will further lead us into this discussion. Over to you, Sankar.
Thank you, Anthony. It's a pleasure to moderate this interesting session. on the opportunities and challenges for the Indian economy. I thank Amiyatosh and Shubhada once again for joining us today. We can clearly see that the despair and the pessimism that gripped the economy after the outbreak of COVID-19 has been gradually replaced by an optimism about a strong economic revival. High frequency data indicators, particularly auto sales and power consumption, are some of the examples which shows and further gives confidence on this economic revival. The vaccines have arrived, and the vaccination drive is also in progress, though a bit slower than the expectation of the government. Google mobility indicators are showing a good pickup. The equity markets are at all-time high, reflecting that optimism, what some would attribute to an irrational exuberance. Large government spending is expected to push up growth over the next 2 to 3 years, and the initiated reforms are expected to trigger a large capex cycle in private sector. However, at the same time, the threat of the pandemic is still very much there. We have seen a surge of fresh infections in some of the states thanks to the mutant variants, and we still don't know how effective the vaccines are against the new variants that are going to come. There is also the threat of higher oil prices, retail fuel prices, which has sharply risen in the last couple of months. And this can trigger another bout of higher inflation, though it is, as of now, seems to be under control. Yeah. Now, to get a balanced perspective on these issues, I will try to pick the brain of our eminent panelists. And first, let me come to you, Shubhada. Shubhada, we know that you are one of the most experienced economists in the country today. We saw in the presentation that Karan presented that most domestic and global agencies have projected double-digit growth for FY22. Many key indicators have attained the pre-COVID levels in December or Jan 2021, and vaccination has made some progress. Now, I have two questions for you. First, what are the downside risks you see to these double-digit growth forecasts? And secondly, what would you believe can be the average growth for the economy over a slightly longer term of 3 to 4 years? That is FY22 to 24, and what can drive that kind of growth? Sure. So over to you, Shubhada.
Thanks, Shankar. Thanks for inviting us to share our outlook and views on what is in store for us going forward. As you rightly said, I mean, this has been a most unprecedented year, and going forward, while the risks still linger as far as the virus is concerned, we are not completely out of danger. But a large part of danger is hopefully behind us. And of course, the recent spurt in cases will need to be monitored very carefully. But having said, a double-digit growth is something that almost everyone is penciling in, purely because the first half of the last year, that is the fiscal 21, was a washout year. I mean, we had seen a dramatic contraction in the economic activity thanks to the stringent lockdown conditions which were necessary at that point in time. Right through the contraction lingered through the second quarter of the fiscal 21 as well, taking the average negative growth to about close to 16%. So purely on the base, even if there is a marginal improvement in the economic activity as we see increasing, unlocking kind of scenario playing out, that itself will give a kicker, as we say, in base for that growth to pick up. But let's completely keep aside the first half of the fiscal 21 and the first half of fiscal 22, which we believe is going to be, cancelling out. What is important is to look at is the organic growth from there on. Now, why we believe that there is a probability of India still getting back to the double-digit growth, not back, actually getting into an unprecedented 11.5% growth is what we are looking at, is purely because, as Karan was also presenting in the in his discourse, manufacturing is beginning to pick up very rapidly. Most of the manufacturing sector output, over half of it, 57% of industrial volume, is pre-COVID levels, and the demand conditions are definitely getting better on the back of rural consumption. So demand in the economy is for sure improving as we move forward with the increasing phase of unlock happening. The more important one is the services sector, which was more contact intense. Now, these are the ones which we believe going into the second half of the next fiscal year, that is fiscal 22, will see a significant amount of a bounce back. And that is the reason, because those are the ones which had actually contracted very sharply in fiscal 21. That is the year we are still going into, rather we are in. So in nutshell, the manufacturing incremental sequential improvement and a very sharp bounce back of the services sector, which had seen the biggest brunt being borne thanks to the lockdown, will together collectively take India's GDP to 11.5%. But as you said, the risks are not behind us. The virus still lingers on. So we assign almost a 65 to 70% of probability to 11.5% growth. But what if there is a resurgence and a second wave of virus, or for that matter, the vaccine rollout is much slower for covering the larger segment of population? If that scenario plays out in the coming months, these coming 3 or 4 months are very critical for that. If that happens, we will definitely see at least 100 to 150 basis point cut from our forecast, say taking it to 10%. And if we have a completely worst case scenario, then we will clearly look at least 3.5% of a cutback. So to put it in a nutshell, where the growth lies, the higher probability is 11.5%. But as the risks are getting embedded, we will have to keep them in mind to make sure that the growth range is somewhere between 8 worst case to 11.5 best case. So coming to your second question is, going forward, where do we see? Now, let's not forget, if COVID had not happened, our growth trajectory would have been significantly better, because we were seeing a capex which had been undertaken by the government in the fiscal 21 itself, even before COVID struck us. If that were to continue, our growth trajectory would have been significantly different compared to post-COVID. Where has our growth trajectory going to be playing out? If I were to make a simulation and scenario analysis, it would tantamount to saying that we are seeing a permanent scarring of output and permanent damage, so to speak. What do I mean by that? That means if COVID had not happened, we would have grown at least 200 basis points more than what we would grow once we are normalizing it. So there is a 200 basis points of kind of a permanent scarring that we see. And if I were to put it in numbers, we will be glad to see a 6.5% post, the noisy years of fiscal 21 and fiscal 22 are behind us. So even after that, if between 22, 23 onwards, if we next couple of years we see 6.5 to 6% or thereabouts, it'll be a great achievement. All depends on how the budget measures that were announced actually get implemented, because a lot hinges on the growth impulses which are being identified to be leading through, as Karan was also talking about, Keynesian way of looking at it, that capex-led growth, which has a significant multiplier, almost 7 times than revenue expenditure. And that is going to be extremely critical to take India back to a much robust and sustainable growth path. So overall, while we do see setback in terms of otherwise normal growth trajectory, but that's happening to the rest of the globe also. So on a relative scale, I think India would be better off in terms of the pace of growth that it manages to achieve over the next 3 to 4 years.
Thanks, Shubhada. Let me come to Amiyatosh for the next question. And Amiyatosh, you must be looking at India. You are teaching in US, and you are not just looking at India, but all the BRICS countries and China as well. So my question to you is, how do you rank India's growth potential in FY22 and also beyond as compared to the other large countries such as China and BRICS nations? Do you think that the country has the firepower to deliver an average growth of over 7% consistently in the next 3 years? So that would be what I would like to hear you about.
Great question. Thanks, Sankar, first of all, for having me here. It's a pleasure to be here. Two parts to your question. One is how does India fare compared to international large economies, BRICS economies we get compared with all the time? And I'm fairly optimistic that India will be the largest, the fastest growing economy among major economies, major developed economies over the next 2, 3, 4 years. There seems to be a consensus that next year, indeed, we are going to be a double-digit growth economy. And Shubhada talked a lot about this year. So let me focus on long term and that in the next 3 to 5 years, how do we see ourselves growing? And first thing, leaving this pandemic aside, if we end up getting another strain and another attack, and of course, all bets are off. So as long as our health situation is under control, I think we have the potential to grow at a rate of 6-7%, even in the long run. And this budget has set the stage for that. This budget has set the stage for a long-term structural growth. So what I like to do is get back a little bit to why our growth rate had tapered off before COVID hit us. And then talk about how this budget helps us fix some of those structural problems if implemented correctly. So that will be the key if that I'll have in my statements. So the seed of our economic woes were sown 10, 12 years ago, not 20, 10, 12 years ago. So we those of us who are in finance, we look at the banking sector. We look at tremendous growth that we saw around 2007, 8. A lot of investment happened in India. Our economy grew a lot. And a lot of that was funded by debt. And the debt that banks made, unfortunately, not all of them were prudent lending. So when we had our asset quality review in 2014-15, thanks to Raghu Rajan, we saw the problem, the non-performing asset that our banks are sitting on. And to me, credit flow is like blood flow. I often like to tell my students, credit flow is the blood flow of the economy. You had this banking sector sitting on tons of non-performing asset. Then after that, the host of reasons that why they will not be lending. They become risk averse. There are incentive problems. There are risk aversions kicking in. Capital requirements becoming binding. So we survived for a year or two after 2015, thanks to Nvfc lending. So Nvfcs were lending and we still had consumption, debt-driven consumption growth. And then ILFS happens. And what you ended up having is your financial sector was in a massive trouble. The banks were having a lot of NPA, and your NBFCs were sitting on tons of these loans and short-term debt. So there was a run on NBFC. So that's the background. And if there are, of course, when you think about the structural drivers of growth in any economy, be it consumption growth, investment growth, or government expenditure, there are many reasons. To me, right now where we are in India, fixing the credit markets and credit flow is the primary reason. So if I diagnose the problem like that, let me see how. Let me just comment a little bit on how our budget is trying to fix that diagnosis, fix that problem. So in the presentation, Karan was mentioning that this whole reform that has been talked about in this budget on the banking sector and the financial sector, be it the creation of ARC, the company to restructure all the bad debts that banks are sitting on. I think it's, look, in banking, we often talk about debt overhang. If you have a lot of bad debt, then you'll not make fresh new debt, okay? So sometimes doing this restructuring will help. Now, the implementation is going to be important, that at what price these bad debts are bought and how does this ARC end up restructuring, selling those loans. So if that is done right, the credit growth will pick up from the banking sector. The creation of this new DFI for infrastructure lending is important. But again, the key there will be that to get right kind of people so that we do not repeat the mistakes of previous infrastructure lending. So once we fix that, the fundamentals of Indian economy remain very strong. If you look at the consumption side, we are a growing population, a young country, so consumption will come. Provide credit, provide this boost to the strength to the financial leg of our economy, and consumption will happen. Once consumption happens, investment will follow. Private investment will follow. In the meanwhile, we are, of course, every economy in the world has become a Keynesian economy. Everybody is doing government-led infrastructure with tons of borrowing. So once consumption picks up, the private sector demand will pick up. In the meanwhile, and that's my final point why I'm bullish on Indian economy, is that the infrastructure investment that the government is making and the rural spending and the rural uptick that we have seen in the recent months together will give a lot of jobs in informal sector, something that often does not get measured by people like you and I. But in the rural economy, in the informal sector, you have employment picking up. That will again boost the consumption. And hopefully a good virtuous cycle will begin in the next few years. So these are my top reasons why I think that India will be able to give you a growth of 6-7%. And these are the things which, in fact, I see this as an opportunity compared to BRICS countries that, yes, we had a problem, we are fixing it, hopefully we'll get back on track.
Brilliant. I think, Amiyatosh, you have explained how budget is going to make a long-term difference to the growth rate wonderfully. And I picked up this catchphrase that you have used, that credit is really the blood flow of Indian economy, and particularly for India, where the loan market is far bigger than the capital market. Suman, let me come to you, and you have been rating 2,000 companies every year, and you review these companies practically every month. So I would like to ask you something about the corporate performance. When you look at corporate performance, where do you think is the growth going to come from? What has been the revenue and profitability growth for India in the current year, FY21? And do you expect to see a stronger performance in the year FY22? So, Suman, over to you.
Thank you, thank you, Shankar. It's great to be in this panel discussion along with eminent panelists. So, coming to your question, essentially, it's a very interesting study that if you look at corporate performance, and what we did was we looked at the top 500 listed companies, and we decided we will look at Q3 because most of the Q3 financials have been published by the listed companies. So we looked at 500 top listed companies, corporate sector, not financial sector, and we compared them with Q3 of FY20 on a year-on-year basis. What the interesting perspective that we got is, one, the revenue, year-on-year aggregated revenue is only contracted by 1.8%. So essentially, it is almost the revenue has caught up to the FY20 levels as far as this quarter is concerned. Secondly, the operating profits or EBITDA has actually grown by almost 13.8%. So what are we talking about? There are two takeaways from this. One, and this has happened in Q2 and which we see repeated in Q3, that there is actually a margin improvement that is visible in the corporate sector, partly because of a lot of cost optimization that has happened during the pandemic and also lower commodity prices. So it is still sustaining. The second is that revenues are catching up, which means that demand is picking up. So if this trend is sustained, and we believe at this point that it will in Q3 and Q4, definitely, first it's in the balance year, this year itself, we might be surprised with an upside on the growth estimates. And secondly, of course, the 11% should be achievable. So what can happen is that in FY22, a part of the margin improvements that has been seen can get a little offset because of the, as Karan talked about, the panelists are talking about the increase in commodity prices that might take down the operating margins a bit. But at the same point, we expect higher growth in revenues. So overall, it should be positive for the corporate sector. And in fact, we are already observing this in this revenue optimism in some of the sectors. One is steel. We are seeing a significant buoyancy in some of the steel companies that we rate. Construction sector is surprising us on the upside in terms of the kind of order book that is slowly building up after September, post-September. So there are quite a few positives which make us quite optimistic about the economy.
Thanks, Suman. I'll go to the next question for Shubhada. Shubhada, inflation has been a major worry for the central bank till October, November, when the headline CPI numbers were moving over 70%, over 7%. However, the CPI print has sharply slipped below 5%, largely due to major seasonal drop in vegetable prices. And the question is, do you believe that we would continue to have stable inflation throughout FY22, or can there be challenges if commodity prices rise further?
Absolutely a valid question, Shankar, because a large part of the inflation path that we saw in fiscal 21 was essentially due to supply constraints, which actually revved up the prices, and they continuously remained for a large part of the year over the upper band of the RBI's inflation target, which is at over 6%. While the winter months are typically the supportive months for these food items led by perishables, led by vegetables, to significantly drop back, and which is what happened, starting from December and January. We saw a plunge in food prices led by perishables to the extent that the headline CPI actually came from 7% to about 4.6, and thereafter close to 4%. No doubt that it was a lot to do with the seasonality of these. But I believe that, from a monetary policy perspective, we also need to equally pay attention to the core inflation, which is ex-food and to some extent ex-fuel. Of course, I'll come back to the fuel prices as well. But core inflation has been significantly stubborn at about 5.5% and upwards. Now, that is what is reflective of the demand conditions also in the economy. And to a large extent, commodity prices will get reflected in that because the input costs start going up. And if there is a recovery of demand being seen in the economy, the pass-through of higher input costs to the final output prices is more feasible, which is what we have been seeing in the recent times of the uptrend in core inflation that we speak of. Commodity prices, we all know, have seen a significant bounce since the lows that we saw in April. The CRB index that we track has actually moved up by 82% from the lows that we saw in April. And across the baskets of commodities, right from crude oil to industrial metals to even agriculture commodities, you have seen a significant, sharp recovery in the commodity prices that obviously is threatening to the inflation trajectory, and particularly for India, where we are still importing a huge amount of our energy needs. And as we look at a capex-led push to growth, we are obviously going to import a lot of inflation through higher industrial metals, through higher crude prices, and so on. But the way our, weightages are in inflation, the food variability drives a lot of the headline CPI inflation. And that is exactly what we have seen over the past 2 months. But what if, the demand continues to get better in the next fiscal year? Will it be a challenge for the Reserve Bank of India to be able to keep inflation anchored around 4%. There is a new framework which is coming up for revision by March, the inflation targeting framework. The MPC is going to be reviewing the whole target. Our opinion is they should also be not just looking at a headline CPI, but also the core inflation, which needs to get looked at more closely from an anchor kind of a perspective. To the question of how are we going to see inflation stabilizing, I think once again the base effect will play. It was close to 6.2% in the year that is fiscal 21. Some of it downside in the subsequent year will be explained by the base for sure, because supplies are getting better, no doubt. But on a smoothened kind of a trajectory, do we see a risk to inflation? Definitely, there's an upside risk to inflation. As Suman was also pointing out, the higher commodity prices will start impinging on the margins of the corporates. And would the corporates, looking at a better demand conditions, be able to, pass through these prices? Will the purchasing or the pricing power, sorry, not purchasing, the pricing power, will it be regained by the manufacturers? I think that is going to be of critical importance to track from here on. But so far, we do see that a 5% anchor still seems manageable, but quite clearly the bias is more going towards the upside, particularly when there's a gush of global liquidity. We are going to be looking at a likely 1.9 trillion fiscal stimulus getting announced in the US. Obviously, that is going to further add and fuel the asset price inflation. And all these dynamics with vaccine rollout, improving traction in economic activity, higher commodity prices, leading to higher interest rates, it's going to be a seriously challenging task for central banks, not just in India, but across the globe, as to when do they time the withdrawal, or not even withdrawal, even speaking about withdrawal. The taper tantrum is not too long ago that we saw had a huge impact, negative impact on the financial markets. I think that is something that central banks across the world, including India, will have to nuance. RBI has already begun doing that. RBI has begun to anchor that this significant glut of liquidity that prevails today. If we look at government balances, also cash balances, today is close to about 8.5 lakh crores. The perceived liquidity is somewhere close to 6 lakh crores. But RBI is cognizant of that fact. Excessive liquidity could also fuel inflationary pressures. And that is the reason it started to announce the variable reserve ratio auction so as to anchor and remove the anomalies of the overnight rates, even below the floor rate. And they want to gradually remove the super excess liquidity that still prevails in the system. And to me, that is going to be one of the key challenges, both in terms of inflation management, inflation expectations. So it's not an easy path, even as you get better in terms of recovery. I think that's where the challenges are going to be for across the globe central banks.
Yes, Shubhada, it's very interesting. It will be very interesting to see what kind of stance RBI takes with the monetary policy changes. And of course, I think Monsoon also will play its role in keeping the prices, particularly the food prices and vegetable prices, in control. So let me come to Amiyatosh. Can higher inflation lead to the risk of higher interest rates in FY22? And what will be your thoughts on inflation and the interest rates in India? How do you expect RBI to respond to the challenge of higher government borrowings?
Two parts to your question, Sankar. And the first on inflation and then borrowing, and of course they're related. The inflation one, I think RBI will respond by looking at two things. How big a number we are talking about. We have a framework of 4% plus minus 2. So you can, within that framework, go up to 6% of headline inflation. And all the point that Shubhada made about core inflation, I agree with that. So, but I'm just going to focus on CPI inflation and how RBI might be looking at it. And there, and right now, at some level, RBI has become lucky, right? So we had a bumper crop, and the food inflation came down. And on the other hand, you have commodity, crude oil prices going up, and the petrol prices, of course, everybody is talking about in the country. And they're kind of offsetting each other, right? You have lower food prices, higher oil prices. So when you look at the consumers' net experience, CPI is still under control. And RBI, I think, will be sitting pretty in a no action mode right now. Now, going forward, if inflation keeps picking up, what is important is going to be what's the source of that inflation?
Yeah.
Is it coming from the cost side, or is it demand pull inflation?
Yeah.
Right now, where we are, it's a cost-driven inflation. That is, on a plus side, you have a good kharif crop, so prices of agriculture goods have come down, and commodity prices are going up. So they're both adding to the cost. They're not driven by aggregate demand, that people are consuming a lot, and therefore everybody is having a lot of purchasing power. RBI will intervene if, in my opinion, if the aggregate demand-driven inflation goes up. That's like overheating of the economy. And that, at some level, a little bit of that is good inflation, right? Because you're trading it off with growth. That growth will happen, and then inflation will happen. Right now, and that I hope happens at some point in time later in the year, but right now we are talking about cost push driven inflation. For that, RBI should wait, in my opinion, and let the government play that out, that what kind of subsidy they want to give on petrol and what kind of excise duty they want. So there will be a little bit in the government's domain. Now, going forward, if as and when the economy picks up, and at that time, if it's all demand-driven inflation, at that time, there will be a good case to be made that, hey, suck the liquidity out of the system, because now you start worrying about the asset prices and bubbles and all that. I don't think we are there yet. Now, the bigger issue, I should not say bigger issue, an equally important issue is the government borrowing, the second point that you made, Sankar. And we saw, rather we are witnessing it right now, what's going on to the government yield, 10-year debt. In the presentation, I was talking about that. Government wants it to be around 6% interest rate on a 10-year debt. Market perhaps wants a 6.25%, and there's this fight going on. And so right now, government will continue with a lot of liquidity in the system, because they have to support this massive infrastructure spending. They want to, growth remains the priority. Inflation is a concern.
Absolutely.
But growth is the priority. So my take, so in short, what I'm saying is that right now government will just wait and watch. As long as the cost-driven inflation, they'll just wait. Let's not pick it up beyond 6%. At that point in time, they'll act. But in the meanwhile, they want to keep the rate of borrowing, especially on the long-term debt, 10 years debt, 15-year debt, low. For that, liquidity. So this is a classic trade-off that we people in economics all the time talk about, growth versus inflation. And I think the trade-off should be in favor of let's go for more growth, and let's have government policies on excise duty and other stuff to keep inflation down. That's how I see it.
Yeah.
Amiyatosh, you have nicely put the importance of quality of inflation and not just the absolute numbers, how it's so relevant at this point of time. Let me come to Suman. When we spoke about the higher government borrowings, Suman, how do you see this playing out for the private corporate sector? Can higher borrowing by the central government and the states lead to higher spreads for private sector players? And what is your expectation of banks' credit growth in FY22? Will it pick up after a long hiatus? I think last couple of years we have seen subdued credit demand. So what is your view on this?
Sure. So there are two parts to the question. So I will first come to the first part, which is the impact of slightly of the inching up of the yields, which we are observing right now. And a lot of it will depend actually on how RBI is able to manage the yields, in the face of a significant increase in government borrowings. and to convince the investors. So as Shubhada also pointed out and Amiyatosh also pointed out, it's a very challenging task, not only for the Central Bank of India, but also for other central banks to balance these objectives. And therefore, there is this risk of the yields going up. How will it impact the corporate sector? What I believe is initially the impact will be on short-term interest rates. The short-term interest rates, as Karan also alluded to, has particularly come down. It has sharply come down. If you see the yield curve, it had got so sharp and so low at the lower end of the curve. Now that is obviously not sustainable. Once you try to normalize the liquidity in the system, there will be some increase, I believe, in the short-term interest rates. So some of the large corporates were benefiting from the exceptionally low interest rates, let's say on commercial paper. I think though that will probably will go off a bit. On the longer terms, of course, it will depend a lot, as I said, on how RBI is able to manage the yields on the long-term papers, on the government papers. But definitely there is a crowding out impact that may be on play, because naturally if there is a lot of supply of sovereign papers and sub-sovereign papers, there will be an impact on private sector borrowings as well. So I am expecting that yes, there will be an impact, but the impact will be felt a little more gradually. It will not be so sharp. Second question is on the credit growth. Now, we all know how anemic the credit growth has been, despite the efforts that the government has been making. To some extent, and it's basically the reason has already been talked about by Amiyatosh, that if we have come from asset quality review, there is a huge bump of, peaking in the asset NPA in the banking sector, and naturally there's a system aversion towards credit, particularly in the corporate sector. If you talk to most of the even private sector banks today, the CEOs, they will be talking more about growing their, as they call, RAM book, which is SME, agriculture, retail, but they're not really focusing on corporate. That is one part of this story. The other part of the story is that there was no private sector meaningful capex that was happening. What this budget will do is, and is expected to do, is to incentivize that capex in private sector through this PLI programs that we are talking about. So as far as we are concerned, we will keenly observe how this PLI programs are taking off, how those is translating into what we expect to be a real kind of inflection point as far as private sector capex is concerned. There is a little bit of constraint, I believe, in terms of how banks respond to it. At the same point in time, what I also believe is that initially you will see a lot of this capex that will start will be funded by equity and internal accruals. Remember that a lot of these corporates, especially the top corporates, they have not been doing capex for some time. They have cash with them. They have significant cash surpluses. Their accruals are also healthy. I've talked about better margins. So initially that cash and equity will be deployed, and probably we will see credit growth to be pulled up gradually towards the second half of FY22. So we are not going to see any magical increase in credit growth immediately, but it should get into healthy territory from the second half of FY22. Yes.
Yes, Suman, I think the success of the PLI program is very crucial.
It's going to be a game changer. Yes.
Yes. Coming back to Shubhada once again, and this is the last round of questions that I will ask. Union Budget 2021 has projected 9.5% fiscal deficit for FY21 and 6.8% in FY22, reflecting a large fiscal push to growth. I think these numbers were, these numbers are extraordinary in the recent times. But do you find the budget figures credible at this stage? And do you see any risks in such an aggressive fiscal strategy? Do you think the government's decision to defer fiscal consolidation for the next few years is a good strategy?
Thanks, Shankar. There are a lot of questions in this part of last leg of question round. But before I start, I quite concur with Amiyatosh on the RBI stance of maintaining liquidity, accommodative stance, and only acting upon rates maybe towards the last quarter of fiscal 22. It's not going to jump the gun. And quite concur with that point of view. Coming to the whole host of questions on the budget, there was a significant expectation around this budget because this is an unprecedented time, and the government had also indicated that this is going to be a never seen before kind of a budget. But it actually delivered on most of the elements that all the stakeholders in the economy, domestic, global, were anticipating. And what we liked about this budget are 5 things. One, that it was investment over consumption preference, and that is where the sustainability of growth gets embedded. Second, as a follow-up, was the emphasis on the capex versus the revenue expenditure. Capital expenditure obviously has a higher multiplier, as we spoke about, 7 times big bang to the buck is basically to GDP thanks to capex. Then we saw a job focus rather than SOPs focus, and last and not the least, and we have not enough spoken about it perhaps, is the financial sector reforms. I think these are the 5 elements on which the budget was based on. Coming to this very unexpected huge fiscal deficit that the government announced, and that was the last pillar which it did not speak about, was the transparency. Now, earlier, until this year's budget announcement, a lot of subsidies used to be off balance sheet, that is off the budgetary resources. It would be loans through NSSF to the Food Corporation of India and so on. But that has been actually brought onto the budget. So if I were to normalize it compared to the previous years, this 9.5 actually, if the same non-transparency had prevailed, would have actually looked like a 7.9% fiscal deficit. And that would have continued into the next fiscal year, that is fiscal 22, by 110 basis points. So the whole effort of bringing transparency and bringing all the off-balance sheet items onto the budget arithmetic was a great way. So in a way, I would like to just segregate that kind of a subsidy element going into that headline fiscal deficit number. But even segregating that, the entire build-up and focus on capex is the most welcome step. And this is going to come, a 26% increase in capital expenditure on the back of a 31 or 33% of capex in fiscal 21. Capex is always a cycle. If you see 2 or 3 years of capital expenditure going up significantly, you obviously are trying to create long-term and durable growth impulses. And that is why we believe that this budget has been, in a way, a game changer. A lot of candid views have been given in the budget measures, in the announcements, and so on. Coming to the path of fiscal consolidation, the finance minister did allude to that eventually by 25-26, they will come to about 4% of fiscal deficit. So the goalpost was defined, but the milestones need to yet get clarified. And where does government see a larger fiscal consolidation coming in towards the latter part of that time frame, or the earlier? Definitely not earlier, as the government would want to focus on pump priming kind of a way of revving up growth, revving up the qualitative growth that we all are looking for, job creating growth. And that is why we believe that this was the best window for the government to come out transparent, come out clean about its budget arithmetic, and it delivered extremely emphatically. And from here on, what we do see is the budget row items that have been put forth in on the revenue side of the budget. We believe if there is an implementation going through, then most of these numbers look a tad underestimated rather than overestimated. So arithmetic looks very believable, achievable, particularly on the tax items like a direct and indirect tax. Those are definitely achievable. Yes, the critical point would be disinvestment. Now, years gone by, government has not been able to achieve disinvestment targets, but we believe that if the work has already gotten done in fiscal 21, the government should seize that opportunity and accelerate and expedite the disinvestment right from Q1 and not wait until the H2 of the fiscal year, because that's where usually the game falls apart. So disinvestment is going to be extremely critical. So even, we believe that disinvestment target is not extremely lofty. So if it is executed in a timely manner, it is highly achievable. So on the revenue side, we believe that a lot of row items do give some credibility to the whole number of the tax buoyancy. It's tad higher than 1.3. Typically, long period number is about 1.3. This year is going to be higher, but that is thanks to the bounce back that we will see in the GST revenues and so on and so forth. So, in nutshell, this budget actually delivers on most of these, boxes that needed to be ticked. And what if the rest of the globe is also expanding? I mean, they're spending their way out of the problems. India is trying to get there, but as long as the quality of spending is intact, I think we may not have to excessively worry about the debt GDP ratios if over the next 2 to 3 years they actually start bringing in growth back, organic growth back to about 6.5% to 7%. So I think, the benefit of doubt should be given to the government that this year remains critical, and the financial sector reforms of privatizing two banks, creation of DFI, ARC, and so on, if they are executed to the T, I think India is looking at a longer period of a high quality growth.
Thanks, Shubhada. I think I tend to agree with you on the very important point that you have made, is that the government has done a great job of making the budget more transparent by bringing off balance sheet items into the main budget presentation. So now, since we are a rating agency ourselves, and this is the sovereign rating issue has to be discussed, right? So my question for Amiyatosh is that, we all are aware that debt to GDP is one of the most important factors that rating agencies go by while rating a sovereign. And with the kind of numbers that we are talking about, do you see that if India's sovereign rating is downgraded, it will become a very serious challenge for us in terms of FII inflows? So this is my last question for you, Amiyatosh.
Absolutely, Sankar. And the way I'll make 2 or 3 points on this. One is, and you folks are credit rating agencies, so you are the experts here. But correct me if what I'm saying is wrong. Say 3-4 months back, all these international credit rating agencies came out and they reaffirmed India's investment grade rating. What had changed since then? It has become better. The fundamentals of the economy has become better. So now if S&P and the Fitch and Moody's, they come and say, now suddenly we don't like the fact that there is a 10% higher debt to GDP ratio. You were at 80, maybe 85 at that time in terms of expectation, and the reality is 90. And therefore, you're falling a notch below investment grade. We are just about investment grade, just for the for everyone in the audience. I'll find that a little bit not credible because and these affirmation of ratings happened about 4 or 5, depending on the credit rating agency, 3-4 months ago, when it was kind of clear that that things are the fiscal deficit will go up and the growth challenge remains. So that's my one point, that I'll find it a little bit inconsistent. The second one is more structural for credit rating agencies out there, that why this fascination with debt to GDP ratio? After all, What we are looking at as a credit rating agency, and I do a lot of research in this area, is effectively what is the probability of default. I mean, that is the economic construct that you're after, and whether you assign triple B or a single A. India has never defaulted on its debt obligation. Okay. So the credit rating agencies have to look at it and give credit to a borrower, just like you and I will do to a private borrower who has never defaulted in his or her history of 100 years or 80 years. You'll say, yeah, this borrower looks prudent and takes debt repayment seriously. And the third, more on the fundamental side of it, why I think this will not be a good call to lower India's rating, and therefore I think it will not happen, is debt to GDP has to be seen along with the GDP growth rate, right? The basic economics, right? That the debt repayment, debt burden is going to be high, no doubt about it. What Shubhada talked about, that if we are using that debt for good investments, good infrastructure, that's a good use of that money. And that will give us more GDP growth rate. And there is an identity almost, right? That if our GDP growth rate exceeds our debt repayment obligations going forward, we're going to be fine. So credit rating agencies have to be a little bit forward looking. And the final point I'll make, Sankar, here is that India is not alone in this. If I'm S&P and I'm looking at countries around the globe, roughly, you folks will know the number better, but roughly we are what? We're going to about 90% debt to GDP, and we were around 80 before. So it's a 10% increase, I think, in the debt to GDP ratio, which has been a norm across countries. Everybody is spending. So there's a relative sense in which we are not too bad. Yes, fiscal deficit is growing, we need debt, but it's not extremely extraordinary when we see the context. So the final point I'll make is the credit rating agencies, they look at their model, the past, what has worked. The model that has worked in the past should not be applied when you're evaluating creditworthiness of your sovereign clients now, because the past data is trained on a very different world. That was not a world where a pandemic happened. If we use the past data to rate our countries and companies now, companies are still, you can somehow make an adjustment, but it's still there, you have to make some refinement. But for the sovereigns, it's a very fundamentally different thing that I think will be a mistake in my opinion. So to answer your question, Sankar, I hope that doesn't happen, and I'm giving you economic and statistical reasons why it should not happen. But should that happen, if India's investment grade rating is taken away, of course that's going to cost us. Our borrowing cost will go up, and that will be a risk factor. Absolutely.
Yes, Amiyatosh, I completely agree that ratings are forward-looking in nature, and the rating agencies must have incorporated the future outlook, which was pretty well known at the time of the last reaffirmation of the ratings. And since then, things have only become better for India, and hence we should probably, be optimistic about the rating not going down. I totally agree with you on that. So with that, let me come to the last question to our panelists. And Suman, the last question, you have the last word in a way. What is your prognosis on the asset quality in the banking sector and the Nvfc sector? RBI has already warned about a doubling of NPA by September 2021. Are we witnessing higher defaults in Acuité's portfolio or in the rated portfolio across all rating agencies in the country? And restructurings happening more frequent in the post-pandemic period? So Suman, over to you.
Sure. Thanks, Shankar. So I think this is a question that I guess a lot of market participants are very interested to know on how all this that we discussed will translate into the asset quality, the health of the portfolio of banks and the non-bank lenders. Now, as far as the ground situation is concerned, I mean, when we look at our portfolio of companies, when we not only the rated companies, but also the banks that we rate and the NBFCs that we rate, what we are seeing today is actually a little different, honestly, from what RBI's financial stability report has talked about. When they talked about, when they released the report in January, they said that around NPA is 7.5% in the banking sector. As on September 20, it will go up to 13.5%, which is almost a doubling. I guess what I understood is probably they are factoring in a lot of restructuring that the banking sector would do, and they would have all added it up. That's what my understanding is. What we are seeing as far as the portfolio is concerned is slightly different. Yes, there has been definitely a forbearance. We had a bout of 6 months of moratorium, which was necessary at that point in time to give relief to the corporate sector and particularly the SMEs and retail. And then it was followed up by the OTR, program, the OTR scheme of RBI. Actually, what the banks tell us, and even now, excepting for a few large ones, stressed companies, we know about one of the large retailers, we are not really seeing much of movement as far as restructuring is concerned. The one-time restructuring, initially people expected a significant number of companies, and point in time, of course, we will see it finally as we go to March. But based on what comes to us in terms of, assessing the resolution plan, rating agencies do resolution plan for one-time for OTR. We are not seeing that kind of movement, and banks have also kind of reinforced that, saying that actually customers are more interested to pay up and settle their debt, which indicates that the situation is not as bad as probably what RBI is thinking. And if you really also look at what has happened is in our rated portfolio, we see a large number of companies, who has already, there is a moratorium they have taken, right? And which has been converted to, the interest accrued has been converted to a fixed interest term loan, or what is called an FITL. What we see is that many of them have already prepaid or settled that interest, accrued interest. So actually, excepting for some companies who have to pay up that FITL, and which is a portfolio where we will have to track because there is a risk there, but that's not a very substantial part. Most of them have been able to address this issue of the accrued interest very comfortably. So we are really not believing that at this point in time that there will be a spike in NPAs as far as excepting for a few large corporate accounts in the corporate sector. However, and however is a little big, however, the retail sector is something that we will be looking at a little closely. If you look at the commentary of the banks and some of the Nvfcs, there is a risk factor which is a little emerging in the microfinance sector. There are reports of delinquencies in microfinance in certain pockets of the country. There is also a concern on unsecured personal loan. While job losses have not been much, but it is fact that a lot of employed people have been maybe over leveraging themselves and thinking that the salaries will go up, which has not materialized. Maybe some of them didn't lose their job, but they had salary cuts. So they're finding it difficult to pay up those personal loans, which they've taken for personal consumption. So that's unsecured personal loan is a risk factor, and commercial vehicles. Commercial vehicles, hopefully part of it will get addressed as the industrial recovery takes place. But there has been a little bit of a problem on the commercial vehicle portfolio of NBFCs. So these are some of the elements where we see some bit of delinquency risk on the retail side. But as far as corporate and SME, we are not expecting a real spike as of now. Yes.
Suman, I think you have very nicely put forth the segments of the economy where the real risk will be. And the MFI sector and the retail sector will have to be closely observed going forward. So I once again thank Dr. Amiyatosh and Dr. Rao for simplifying the complicated subject of economics for us who are non-economists. And I hope that you enjoyed the questions. I can assure that we enjoyed your answers a lot. So, Tony, over to you, and you can take it forward from here.
Yeah, so I'm not letting the panelists go soon. a couple of more questions maybe from that we have received from our participants, and also we received some questions over email. So the first one to you, Dr. Rao. Specifically, you have been touching upon the subject of capital expenditure. So the states have limited fiscal flexibility in the post GST scenario to raise fresh taxes, and their fiscal health has got impacted due to pandemic and also due to lower tax transfers from the center. Since a major part of the capital expenditure is undertaken by states, will not their weak fiscal position affect the overall public expenditure in new asset creation? And how will the central government ensure that capex is not postponed by states? Your views on this, Dr. Rao?
Great question. I think I can just say fresh from the mint. I've got a view, just earlier in the afternoon. Was this is exactly the question I had put forth to the expenditure secretary, because let's not forget, if we look at the center, states, and public sector enterprises capex composition, the states and PSCs have a larger share in driving the capex in the economy. But having said, the multiplier is significantly higher from the central government's capital expenditure. It is about 1.6 times more than what the states incur in terms of capital expenditure. But having said, no doubt, states become extremely critical. And we have been seeing that, because of all the factors that you spoke about, the revenue position of most of the key states, I would say about 17 odd would be key states who drive the capex. Their revenue position is not good enough to drive this. And in fact, if you look at the data right until December 2020, they have spent as little as just about 35% of the budgeted estimate from those state government's budgets. So somewhere, if the budget was about 4.4 trillion of those 17 states on capex, what they've actually spent is just about 1.5, 1.6 trillion. So there is a huge gap. And this is exactly the question I did put forth. And, the central government is extremely aware of this, funding challenge from the state governments. And what was being highlighted was that there is something like an incentive structure for the state governments that is, getting to be put underway, which will actually nudge the state governments to get into a capex kind of a path once again. So, some of it was already announced by a 50-year interest-free loan and some of those kinds. But what we were given to understand that there is perhaps more to come to push the states to get engaged in more of capex. So that's all I can, share at this point in time.
And Shubhada, I did not attend that session that you spoke about.
Take it from me.
Another question related, Shubhada, you spoke about a 65-70% probability of 11% growth. Yeah, and you also gave a range, what can go wrong possibly. So related to that, the agricultural growth has been quite robust over the last couple of financial years, FY20 and 21. It's successive good crops in both Kharif and Rabi seasons. What can be the impact of a bad monsoon on agriculture and therefore for the Indian economy?
No, absolutely a great question, because what we have assumed in the 11.5% growth is a normal monsoon. Okay. But if normal monsoon does not play out, the reason, by the way, we took a normal monsoon assumption was, I think some of the private weather forecasting agencies have already put out a preliminary forecast of the monsoon likely to be normal in the year 2021 as well. So that was the reason why we had assumed a normal monsoon. But yes, if the monsoon is not normal, then obviously you have a twin problem. A normal monsoon, absence of normal monsoon, will have its impact on food inflation, will have a kind of, therefore, impact on inflation expectations and therefore in turn interest rates, as well as on the rural consumption, and therefore the dwindling growth impetus which we had seen, remaining relatively intact, because COVID did not hamper rural demand to the extent that it hampered the urban demand. So if that kind of a scenario was to play out of a terrible monsoon, then, then we are definitely looking at, well under significantly lower single digit number. Definitely not 11.5. We could look at a 7 and 8. And if we look at on a net basis for 2 years gone by, fiscal 21 and 22, collectively, it would be a shocker of a growth. So as of now, we've not penciled that in. But yes, it's a great question. And we'll continue to monitor that. But on the constructive side, hopefully the capex will start kicking in and the jobs, the rural jobs may get a leg up if there is infrastructure-led growth. I remember a long time back when there were 2 years of continuous famine kind of situations, and a lot of analysts like us had actually forecast a very dismal growth scenario. And to our surprise, a positive one at that, the growth did not correct to the extent that most of us had anticipated, purely because that was the year of the GQ and East-West, North-South kind of, and those were the 2 years. So there was a kind of substitution of the job opportunities which came by the countryside and the rural economy. If not agri, people were actually going to infrastructure projects and were able to earn an income, and therefore consumption remained intact. So we are hoping that, God forbid, it should not happen. But in that case, the spend on infrastructure will assume even larger importance and significance.
Absolutely. If I can add and turning a little bit to what Shubhada rightly mentioned, I will just draw my one anecdote discussion with one of the large rural finance, tractor finance companies. And it was just a few years back, and the CEO of that company had told me that, look, when we were asking him about tractor demand and the linkage with monsoon, he said that that's actually a kind of a myth today. He said a large number of tractors today are not used for cultivation. There are other purposes of tractors. They're used for construction in the rural areas. They're used for transportation. There are other purposes of tractors. In a way, the point is that there is a little bit of delinking of monsoon from the rural economy that's already happened. And therefore the kind of exposure that rural economy has on the monsoon has been progressively coming down. So I would tend to agree with what Shubhada just mentioned.
Another question from the chat box for you, Suman. How is the health of the consumer? Can rising commodity prices be passed on to consumers to sustain corporate profitability?
Right. So the point is inflation. There is already an expectation that inflation, we have seen that vegetable prices are moderated and inflation has come down. Food inflation has come down very drastically. And the kind of kharif crop we have and the kind of, there is limited possibility of a food inflation spike in the near term. However, what can really, create a bit of a problem is obviously the cost push inflation that Amiyatosh talked about, oil prices getting higher and we importing that inflation. So, and in industrial, companies passing on that definitely that can lead to some kind of a pressure on the consumption. It can impact the consumption behavior, but I don't see that to be very significant. Shubhada talked about the expectation of a 5% CPI, and some of these things would have been factored in already. We are not expecting that inflation will slip to 4% or something like that. It will remain elevated, but it's unlikely that it will completely go off balance. So that's unless, of course, the disclaimer here is the oil prices have to remain within a certain limit. And if oil prices tend to go to $100 a barrel, the picture is going to be completely different.
Yeah, exactly.
Yeah. So I think the point is, are we expecting inflation to go very sharply higher? Unlikely. In the near term, but of course a lot of it depends on oil prices. And as far as the margins of corporates are concerned, I've already said that there will be an impact on, because but the margins have been pretty healthy, so it will get rationalized to an extent. Yes.
Okay. So there is a specific question for you, but before you, I'll come back to Dr. Amiyatosh. Maybe I'm pitting Dr. Amiyatosh against Dr. Rao's views. Dr. Amiyatosh, when do you expect to see an increase in interest rates by RBI? The bond yields have already started to increase since the budget. Now, can that impact the expected private sector and infra investments?
Economists like to be pitted against each other. That's in you did no wrong there, but we are kind of agreeing on this, unfortunately, here. And so, but to answer your question, Tony, the expectation is that right now they'll still remain very accommodative. And I was reading the MPC comment, but
Absolutely.
question also to put a global perspective on that. If you look at Jerry Powell here in the US and ECB across the globe, I think there is a common understanding, and it goes back to what we learned from the Great Depression in the 1930s, that when economy is in this situation, you got to be very accommodative in terms of monetary policy, and growth becomes important. Inflation is something that can be tamed with some changes here and there to a large extent, unless you start talking about runaway inflation. So the short answer is that right now, I think it will remain accommodative. Interest rate will remain reasonable. And once the demand side picks up and then you have good inflation that is driven by growth, then interest rate, all bets are off.
Okay. We'll take last two questions. One is, what is the kind of, this is to Dr. Amiyatosh, what is the kind of capital inflow scenario that is expected and its impact on balance of payments and growth? Are you going to take that?
Yeah, sure. And I hope I'm getting the question right, that it's the foreign capital.
Yes, that's right. I think, yeah.
Look, what we have seen in the last few months, FPI, the foreign capital has flown in quite a bit in India. And if I'm not mistaken, India has been one of the favorite destinations for foreign portfolio investors in the last few months. And again, financial markets are forward-looking. It's last few months, people have seen the fundamentals of the Indian economy. So on that front, the fact that our GDP is going to grow in double-digit and long-term structural reforms, if whatever the budget has promised gets carried out, FPI will keep coming in. With a caveat that, and we are seeing that taper tantrum here in the US already, that if yield starts going up in the US,
exactly,
then some of these foreign portfolio investors will find comfort in investing here at a 1.3%, 1.4% 10-year notes. And so that is the balancing act. My take is that, and that's why it's important to see in the FPI in the context of Indian monetary policy and the US and the global monetary policy. My guess is that we'll remain accommodative. So barring a small spikes in interest rates, things will remain a little bit low, which means that people will then, foreign investors will be mostly looking at the cash flows, not the discount rate, not the interest rate. And in cash flows story, India's story is pretty compelling. So to put it a little bit of my professorial hat on, that in terms of the cash flows and GDP growth rate, we are looking very good. In terms of the discount rate, which is the denominator of your valuation model, we are dependent on what happens in the rest of the world. And I'm hoping that the rest of the world will keep that interest rates low, so money will keep coming to us. And of course, after that, you have, and in the interest of time, I'll be short. Of course, once you have foreign portfolio investment coming in, it will impact your rupee dollar exchange rate, but your RBI is sitting on what, $600 billion.
600 now, yeah.
Foreign currency reserve. So we'll not worry they'll have enough firepower to manage the exchange rate within a reasonable range.
Okay.
Also, if I may add here, we've seen humongous buildup in FX reserves, 100 billion net balance of payments in fiscal 21. And this is not going to dry out completely in fiscal 22. We are still looking at, even after a current account deficit that we are looking at, that is, the trade deficit is going to be significantly higher as compared to fiscal 21. So even after adjusting for a current account deficit, we are still going to see an accruing of FX reserves to the extent of about 55 billion in fiscal 22. That acts as a support even for rupee. And there was a question on rupee that if there is a bias of real effective exchange rate based bias towards weakening, why is it that we are penciling in a stronger rupee? And it just boils down to two things. One, that US is trying, we expect a US weakness to come back for this year, that is 21. US is trying reflationary policies. Our inflation, hopefully from 6.2% will start normalizing. So inflation differential, which drives your real effective exchange rate, will start normalizing and narrowing once again. But more importantly, the demand supply of dollars will be in favor of supply of dollars remaining intact. So despite some depreciation bias basis real effective exchange rate, we will still see rupee appreciating it. At least that's our opinion, that's our view, that rupee will still end up showing an appreciation from current levels, maybe to about 71.5, 71 levels over the next 12 months.
Okay. Suman, the question to you is, what is the view for commercial real estate, as many large corporations or MNCs are still working from home, whereas there are organizations, some organizations which have a huge portfolio on the commercial real estate portfolio side, like Blackstone possibly, who are bullish on the same. Your take on this?
Yeah, I guess we have overshot the time, so I will try to wrap up quickly.
This is the last one, yes.
Yeah, so I think commercial real estate is one area where obviously we will have to, there is a little bit of a new normal, which I believe will be playing out because of the fact that, the pandemic has shown people how part of the workforce can at least work from home. Having said that, at the same point in time, once we return to a more normal state of affairs, it's very unlikely that corporates will do away with office space. There is the interesting part is, while people have concerns on commercial real estate, let me tell you the other picture, which is about REITs, real estate investment trusts. In the last almost 1 year, little beyond 1 year, we had three REITs which have been listed. It started with Embassy, then there was one by the Raheja, and recently we had one by Brookfield, right? And they were able to get a lot of investors. So as far as the marquee, the big corporates are concerned, the multinationals are concerned, then as India attracts more FDI, I believe that there will be demand for quality office space, that there is no taking away. As far as maybe the mid space, where people are looking for smaller offices, maybe there will be some companies may look for even smaller offices. If somebody who was looking probably at 15,000-20,000 square feet, he may be happy with 10,000 square feet or so. So there may be a bit of a little bit of a structural change in the commercial real estate market. But as far as the large commercial office space is concerned, the retail space is concerned, and I'm talking about the period when we will come out of this, the whole pandemic, I think will return to normal. I don't expect any major problem as far as large office space and large commercial, that is mall space, is concerned. We are going to see a better scenario going forward.
Thank you so much. So with that, we'll conclude our audience Q&A session. Thank you so much, Dr. Amiyatosh, for adjusting with our schedule. We had you really join us early in the morning as per your local US time. Thank you, Dr. Rao, for your time, and to all the participants for attending our virtual panel discussion. I hope each one of you gained some important insights from today's discussion. The full recording of this discussion will be available on our YouTube channel, Acuité Group, for you to share with your colleagues and industry network. If you wish to know more about Acuité, please visit our website, www.acuité.in. We publish regular research and opinion reports on various macroeconomic indicators. We have also recently launched a new monthly report titled Acuité Macro Pulse. Stay tuned on our social media handles for updates on our webinars and other developments. Thank you so much. We hope to see you again. Thank you. Good night.
Thank you, Shankar. Thank you, Anthony. Thank you, Suman. Pleasure.
Thank you,
Thanks,
Shubhada.
everyone.
Thank you, everyone.
Thanks.
Thank you, Amiyatosh.
Thanks, and great meeting you.
Lovely
Thank
meeting
you.
you too.
Thanks.
Thanks, Karan.
Thanks.
Thank you. Thank you.
Bye.
Thank you.